Good afternoon, everybody. Welcome back to Cilinix Crypto and welcome to this new video. A little bit of a different video today because we will not do a standard middle of the day market update. No, we will talk about fundamentals. Very exciting, but very important mostly. All right, so we'll talk about what is going on and what is causing the bearish pressure in financial markets, but also the bearish pressure for crypto specifically right here. So you have a bit more of an understanding of what's going on, hopefully at the end of the video. I spoke about this a couple of times in my videos this morning, talking about that I would make this video, talking about what is going on right now, mainly in the United States, but we all know how relevant the United States still are for the financial markets and for the crypto markets. So let's talk about that. Now, first of all, to start off with a summary of what's going on, I would call it a liquidity crunch. All right. So what that basically means is that there's some sort of a constraint on liquidity, aka cash, in the United States. So that matters for banks that need a lot of cash for their day-to-day operations, but well, all sorts of stuff. Also, other cash-related businesses. It is a major business, right? And ultimately, cash is very, especially in this economy that we have built, that is very much running on debt. Both short-term and long-term debt, cash and liquidity is I would use those as synonyms in this context, and that is very important. Now, there's been a constraint on cash, right? It's difficult to get cash, and if banks want to get cash, they have to pay a higher interest rate. That is what has been going on in October already. That started already last week, but that has been going on especially also at the end of last week, causing a lot of bearish pressure in the markets, and also at the start of this week. So that is what's going on. And there's multiple ways we can see that. You can, for example, see that if you take a look at this. This is the spread between the SOFR, which is basically the short-term interest you have to pay for debt, and the more long-term interest. Look, I'm making it much more simple than this chart is, but what this is showing you is that short-term debt is trading at much higher interest than long-term debt. All right, so that means that demand for short-term debt is getting higher, or supply of short-term debt and liquidity. That's what it is basically, because debt is cash and cash is liquidity. That's decreasing. So banks and other businesses have to pay a higher interest rate for the cash and for the money that they want to borrow, right? That's bad. That's a constraint that creates a liquidity crisis like we have right now. And that is also something we see right here, right? So if you take a look at this, these are repo operations, right? So this is basically when businesses that need cash put up their securities. So that could be treasury bonds, that could also be mortgage-backed securities. They put up those securities and they get cash short term. All right, that is a repo. Repo is basically that you put up these equities, you get some cash, and then you buy back the equities. But you need the cash to fulfill all the business operations that you have to do, and you can do that with cash. You cannot do that with equity, right? Or equity securities. So you can see this has increased significantly in October. Going into last week Friday, it was incredibly high. And yesterday it was incredibly high as well. And you can see the entire year, like this is the highest in this year. Dare I say, this is the highest we've seen in multiple years, right? You barely see something like this. The last time we had massive repo operations like this was during the Corona crisis. Okay, so this is bad. This is bad. If you look at this spread, this is also increasing. This is also not great. All right. So there you can see that there is a liquidity crunch. Now, what is causing this? It's a lot of things. All right, it's quantitative tightening, which you can see right here. So this is basically showing you that the Federal Reserve is not buying back as much securities as it bought before, right? So it basically means that loans that the Federal Reserve bought, again, I'm very much simplifying it, but okay, loans that the Federal Reserve bought and they run out, right? So it's a 10-year loan, they buy it, it runs out after 10 years, they don't use that cash to buy it back. That's what quantitative tightening is. the Federal Reserve has been doing quantitative tightening since 2022, and this is just decreasing liquidity. That is what it is. Now, there's a couple of other things going on. There's more regulation, right? So banks have to keep more cash on their balance sheets. So that also means that they have to keep more cash. That means that there's less cash to do their day-to-day operations. And the United States Treasury has also been issuing a lot of treasury bonds. All right. So what happens then is you have these banks and MMFs, money market funds, market makers, whatever. They buy up these treasury bonds, 10-year, 5-year, 2-year, with their cash. And that means that they no longer have cash, but they have these treasury bills. And that is also one of the key reasons. Look, the US Treasury has been doing that for some time, right? So that's also why you can see the spread. So basically the demand for these for that short-term interest, you can see that growing already. And I think the United States has gone a little bit too far with those with quantitative tightening, first of all, and with the Treasury bond issuance, right? And I think those two things, going too far with that, is what's causing that. Now, is what's causing this liquidity crisis. That is what's going on. And ultimately what that means is that there's not enough cash. So where do they get the cash? They get it from equities. Where do they get that first? Risk on equities such as crypto. Now, I'm not going to deny, if you look at Bitcoin, that since the 10th of October, we've seen a something break in crypto as well. But ultimately, the price action we've seen so far, at least for Bitcoin, can very much be explained by these fundamentals as well. I have to be honest, a lot of these fundamentals and a lot of these things that have been going on went under my radar for too long, which is not amazing. I should have known about this. But not anymore. Now I know about this, and ultimately at this point of time, the spread, as you can see right here, is still very high. The repo operations are still incredibly high as well. So that what that means is that until we've seen that market calm down a little bit, I'm going to remain risk on, all right, or risk off. My apologies. So that means that I expect prices to push down lower. If we see positive development, all right, or if we get some sort of news, right, if the Federal Reserve now comes out and they say, okay, we're going to decrease regulation, or they say, okay, we're going to stop quantitative tightening right now, or they say we're going to start some sort of short-term quantitative easing, then we can instantly recover, all right? And Bitcoin can easily do something like this. That is a possibility. If we get measures by the Federal Reserve, we can easily do this. And similarly, if we see the repo operations decrease, if we see this spread, which I'll keep you updated on, if we see this decrease significantly, Bitcoin will also be able to bounce back up. But as that is not the case when I'm making this video, I'm going to remain risk off and say, I think it's a little bit more likely we'll push down lower. Those are my thoughts. That's the information you need on what's going on right now. I will keep you updated on that as well in all of my videos in the future. So keep your eyes out for that. And that is what were, my expectations given how the situation currently is. I think at some point of time it's going to settle, right? I don't expect this liquidity crisis to endure forever, but the market will bounce until it's over, or until measures will be taken by the Treasury or by the Federal Reserve to stop it. And those are my thoughts, and that's what I think you need to know. So hopefully it helps. Thank you for watching, everybody, and bye.